National Australia Bank's profits beat all expectations today, a whopping 63% rise in net profits to more than $4 billion on the back of a strong second-half performance. A big fall in bad debts and an equally big rise in earnings from business banking were the key drivers, but the size of the profit will again fuel debate on whether banks are making too much. In a moment, we'll hear what CEO Cameron Klein thinks, but first this from Andrew Robertson.
Between them, Australia's big four banks report their profits a total of 8 times a year, and 8 times a year the story is the same. They're rolling in money. National Australia Bank is the latest to have its turn, with Chief Executive Cameron Klein saying all divisions made significant contributions.
I think we see the business bank having lent strongly and being the most active business lender through the crisis and grown market share. A very pleasing rebound in our personal bank, particularly in the second half, which is really showing that our strategy there has genuine momentum and a point of differentiation from our peers.
Net profit was up 63% to $4.2 billion as the improving economy saw bad and doubtful debts slashed. On the other side of the ledger, business banking, personal banking and wealth creation all reported earnings increases of more than 30%. It was a result that was better than the market expected, with NAB shares rising more than 2%, also helped by a 6 cents a share increase in the dividend.
The market was looking for a fair bit of erosion in terms of the bad debts, but that just wasn't there in the result. Bad and doubtful debt charges were a lot better than what the market was looking for, and I think the other big surprise was the turnaround in the UK. It wasn't anywhere near as bad as what the market was looking for.
In fact, the combined earnings of the Clydesdale and Yorkshire banks jumped 53% as economic conditions in the UK began to get better. Despite the good performance, though, National Australia Bank has joined the other members of the Big Four in fuelling speculation that it may raise interest rates for borrowers outside movements by the Reserve Bank.
The average cost of funding is rising. The marginal cost has stabilised, and that's pleasing, but the average cost is rising as we roll off cheaper pre-GFC funding and roll into more expensive post-GFC funding.
That continued implied threat of higher borrowing charges for customers has intensified the debate about the size of bank profits and given ammunition to those who want the big banks reined in. But while all the headline profit numbers are huge, they're not the best basis for an informed assessment of whether the big banks really are making too much money. Profitability needs to take account of the shareholder funds or capital invested in the business, and it's for that reason that banking experts the ABC spoke to believe return on equity is the most important number to look at.
That's the return that they're looking to measure against the other types of investments they could put their money into.
If a bank's doing well on the cost-to-income front and they're doing well in terms of the net interest rate margin, and also their bad and doubtful debts, that's another critical factor, then that'll all flow through to profitability and hopefully at the end you'll get a nice return on capital coming out the other end.
National Australia Bank's return on equity is just over 13%. Commonwealth Bank is approaching 17%. ANZ and Westpac have yet to report their full-year profits, with last year's figures heavily impacted by the global financial crisis.
If you're getting into the high teens, I think you might be starting to have a case to argue that, a lack of competition is resulting in a level of market power that some people might want to seriously examine.
Which means at this point in time, using return on equity as a guide, only the Commonwealth Bank is approaching the territory in which Paul Layev says earnings could begin to be called excessive.